This is an Uncovered Japan Company research report on Yokogawa Bridge Holdings, ticker 5911. Japan's top steel bridge maker has just made a consequential move, buying a leading pre-stressed concrete bridge business. The result is the country's only listed bridge engineer that can work across both materials. In this video, we look at what that means for the business, its margins, its dividend profile, and the questions investors should watch. At the June 14, 2026 report date, Yokogawa traded at 13.9 times forward earnings and 0.86 times book value, with a 4.31% dividend yield. Its FY26 operating margin was 9.4%. Those figures frame the case: a profitable, asset-heavy engineering specialist, valued below book, but with near-term earnings affected by softer new bridge orders and acquisition costs. Yokogawa is not simply a bridge fabricator. Its historical core is steel bridges, designing, fabricating, and erecting new bridges, then inspecting and maintaining existing ones. The group also builds standardized steel frame factories and warehouses under the YES brand, makes tunnel segments and underground structures, and supplies high-precision metal frames for equipment. That spread matters, because the demand cycles are different. Bridges accounted for 54% of FY26 sales, while system construction accounted for another 30%. The bridge business is tied largely to public infrastructure and the shift toward maintenance. The YES business serves factories, warehouses, and stores, so it is more exposed to private capital spending. Combining the two gives Yokogawa a more balanced profit base than a pure public works contractor. Revenue was 143.9 billion yen in FY26, down from the prior year as new bridge orders softened. Over 5 years, revenue was broadly flat. Yet the central quality signal is the margin. Yokogawa has sustained roughly a 10% group operating margin, high for Japanese bridge engineering. The report attributes that to technical evaluation scores, proprietary maintenance methods, and in-house fabrication capability. FY26 operating profit was 13.5 billion yen, and net income 8.7 billion yen. Both were lower than the prior year. The two drivers were weaker new bridge activity and costs connected to the acquisition of BR Holdings. That makes the current earnings base an important distinction. The strategic value of the deal is not yet the same thing as immediate reported profit growth. The report's moat case rests on capabilities that are difficult to replicate quickly. Public bridge tenders reward a long record on comparable structures and a deep bench of qualified engineers. Maintenance work also relies on proprietary methods, where pricing is less commoditized. The BR Holdings acquisition adds a further distinction. Yokogawa can now bid across steel and concrete, an option that is increasingly useful when a project requires the material best suited to its site. Cash flow needs context. Operating cash flow reached a record 43.0 billion yen in FY26, after 3 negative years. Construction contracts create large working capital movements as projects are billed and collected at different stages. The record year is positive, but investors should not simply annualize it. The recurring question is whether cash conversion normalizes as the acquired business is integrated. For income-focused investors, the shareholder return framework is a meaningful part of the story. Yokogawa has a progressive dividend policy with a 3.5% dividend on equity floor, and the report notes 5 straight annual increases. It has also bought back stock. The trade-off is that the dividend policy has to coexist with integration spending and the balance sheet effects of the acquisition. Management's long-term vision aims to move from FY26 revenue of roughly 144 billion yen toward 300 billion yen. The nearer FY27 estimate shown in the report is 200 billion yen, reflecting the newly acquired operations. Execution depends on 3 practical levers: winning maintenance work in Japan's aging infrastructure, capturing synergies from the concrete bridge acquisition, and improving productivity in a labor-constrained construction industry. The report's own scenario framework is deliberately wide. From a June 14th share price of 2,886 yen, the 3-year bear case is 2,400 yen, the base case is 3,500 yen, and the bull case is 5,000 yen. These are the author's estimates, not forecasts or recommendations. The range highlights the variables that matter: order timing, integration, margins, and whether the market rewards the business with a valuation closer to or above book value. Yokogawa Bridge is a differentiated Japanese infrastructure company, a margin leader with a broader product mix than most peers, and now a unique steel and concrete bridge platform. Its below-book valuation and progressive dividend make the case worth following. The risks are equally concrete: cyclicality in new orders, acquisition integration, and the timing of maintenance demand. For the full 5-part research series, continue with the free deep dive at Uncover Japan. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.